2008 showed us that bad bets made on the housing market could destroy even the biggest players in the US banking system. The US went into economic turmoil, and the president at the time, being Barack Obama, introduced what is known as the Dodd-Frank Act, which had the intention to promote the financial stability of the United States by improving accountability and transparency in the financial system, to end the phrase too big to fail, to protect the American taxpayer by ending bailouts, and to protect consumers from abusive financial services practices. And within the Dodd-Frank Act, there is one part specifically designed to stop banks from acting like a hedge fund, and it's known as the Volcker Rule. Welcome back to my channel. My name is Reese, and today I am going to be talking about the Volcker Rule, and I'm going to reveal why later on in the video after I provide context of why it's important to understand what it is, how it works, and what it was intended to do when it was enacted. The Volcker Rule, in simple terms, was aimed to put some controls in place for banks to stop them from making risky bets with their own money, which could see the US financial system reliving what happened in 2008. Paul Volcker was widely credited with ending the high levels of inflation seen in the United States during the 1970s and early 1980s. He was an American economist who worked his way up and eventually became chairman of the Federal Reserve, and he remained in that position for 2 full terms, being 8 years. Paul was extremely critical of banks, saying that their response to the global financial crisis was inadequate, and he called for more reform and regulations surrounding the banking system. Specifically, he called for the breakup of the nation's largest banks, prohibiting deposit-taking institutions from engaging in riskier activities such as proprietary trading, private equity, and hedge fund investing. On the 21st of January 2010, President Barack Obama proposed some new bank regulations, which he coined the Volcker Rule, which was in reference to Paul Volcker's aggressive pursuit of these regulations. And sadly, Paul passed away at the ripe age of 92 in 2019. Okay, that's context. Now for some more. You see, when a company fails, people get hurt, and the flow-on effects branch out into neighboring industry. When a bank fails, it is a much bigger story. Banks do a lot with our money. They lend it out to people like myself who can go away and use it to start a business or purchase a property. But what they also do is lend that money out to other industry, including other banks. So when a bank fails, the flow-on effects can be devastating for both companies and individuals on a much larger scale. Fun fact, the government insures banks. So from the perspective of the bank, the money that they are playing with is fun money, to put it in very simple context. They know that if they fail, they will be bailed out, meaning they can feel more comfortable taking larger risks. And this is why the Volcker Rule was intended to prevent commercial banks with more than $10 billion in capital from acting like a hedge fund or investing in private equity. And like I mentioned earlier before, it is also intended to stop banks from investing with their own profits, which is known as proprietary trading. The way normal banking goes is the bank will take money from a customer, such as myself, and they'll go away and invest that money into something that's generally low risk, low reward, where when that reward comes into play, they will scrape a bit off the top in terms of fees and account fees and things like that, which is their take home from it. In short, proprietary trading is the opposite, where a bank will take its own money and then go and invest it. The problem comes where if they lose that money, the flow-on effects make their way down to the customer, being myself, who banks with that specific bank that's now just lost their pants. So the idea behind the Volcker Rule was a good one, because limiting a bank's ability to make speculative investments that do not benefit the customer whatsoever is good, because that means it's protecting me, the customer, from the bank doing something irresponsible that would only have the flow-on effects end up damaging me, being the customer. The simplest explainer I can think of is that the US government backs deposits up to $250,000 per individual account holder, per individual deposit-taking institute, being per individual bank. The issue the Volcker Rule tries to solve is that all accounts up to the value of $250,000 are insured by the government, meaning the banks would essentially trading risk-free, where if they made money, they would give you whatever tiny amount of money your account made in interest, and then they would keep the rest. Where if the banks made a shitty investment and lost that money, the government would then top your account back up to whatever it was at, and that would be at the expense of your own taxpayer dollars. It's really quite interesting because there are studies that have been carried out about the intended and unintended effects of the Volcker Rule, and I've linked one in particular down below, which was a really good read. I actually read the entire document and found a lot of insightful information in it. Feel free to access that resource if it's something that you're interested in learning more about. I know the topic can be quite dry, but like I said myself, it's been pretty interesting learning about this, and what I'm about to get to in just a second to wrap up today's video will provide even more context about why I'm talking about it today. Just quickly, while you're down in that description, if I could get you to hit that like and subscribe button down below, it really does help the channel grow. I really appreciate the support, and it does not go unnoticed, so thank you for taking the time out of your day to quickly do that. Anyway, it talks about how the intention of the rule was designed to reduce risks, but because of it, the banks have become more inclined to default systemically because they are now forced to hold a more common asset portfolio. To summarize, I'm going to read a passage from the conclusion of that study because I think it was really well said. It goes like this. The Volcker Rule results in no change to the individual risk to a specific bank, but increases the likelihood of default at another bank due to the constraint on diversification. Essentially saying banks are now forced to invest into specific things because they're not allowed to take more speculative risks in other ways. And that's a problem because if they're all investing in the same things and all those same things fail, then the banks are basically setting themselves up to repeat what happened in 2008. I thought it was a pretty interesting hot take. As a one-liner, the Volcker Rule increases similarity between banks, which is not necessarily a good thing. Now, the reason why I'm talking about the Volcker Rule in today's video is because with interest rates on the rise to combat inflation, I have been seeing a lot of posts on social media platforms that I use asking a very specific question. And that question is circled around if there are households that are at a very real risk of defaulting, what does the flow-on effects from those people defaulting look like on a bigger scale, and how does that affect our financial institutions, being banks? Basically asking if we're going to see what happened in 2008, being the GFC, happen again in some type of capacity, which wiped out a significant amount of wealth when it occurred. If you don't know what the GFC is or what I'm talking about, definitely go and give the video I made on the topic a watch. I've linked it down in the description below as well. To wrap today's video up, at the time of recording this video right now, the Volcker Rule does not apply to financial institutions within Australia. However, banks, credit unions, and similar organizations are all heavily regulated by APRA, which is the Australian regulator for financial institutions. So just keep that in mind, that I wouldn't be worrying too much about financial economic collapse here within Australia, nor would I be too worried about everyone defaulting unless interest rates rise too quickly. And if that happens, there's going to be bigger problems that we're going to be facing when that time comes. So for now, just understanding this concept is really good. It's a good idea to have a concept of why these things were enacted in 2008 and why the things happened in 2008, why they happened, so that this time around you can educate yourself and understand what's been put in place to avoid that from happening. I'm not saying it can or can't happen. I'm just saying that there's definitely a lot more thought that's going into these processes today because of what happened and how bad it was. With that being said, I hope that I was able to provide some clarity on this topic. I hope I introduced something to you that you might not have been aware of and now maybe have that stored away in the back of your mind for a rainy day if the topic ever becomes relevant. I hope it was somewhat insightful. If it was, please hit that like and subscribe button down below. And that's pretty much it. Hope you enjoyed today's video, and I'm going to leave you there. Have a good day, have a good week, and as always, I will see you in the next one. Bye for now.